If you are trying to figure out whether it's safe to buy a house in 2026, the first thing you need to know is that the U.S. housing market doesn't actually exist anymore. That single unified market has shattered into three completely different realities. The latest data tracking 33 of the largest, most expensive cities in the country reveals a massive geographic fracture. Depending on your zip code, the rules of the game are entirely opposed. Look at this map. In 27 of those 33 major markets, mid-tier home prices are actively dropping from the all-time highs we saw just a few years ago. But look over here at cities like New York, Chicago, and Omaha. They're completely ignoring the downturn, steadily inching up to brand new all-time highs. And then there's San Francisco, operating as a bizarre microeconomic anomaly with a completely distinct set of rules, driven by localized tech money. Relying on national headlines to decide if you should buy a house locally is going to lead you to the wrong conclusion. You have to know exactly which of these three markets you actually live in. To understand how the market broke apart, we have to look back at the extreme distortions between 2020 and 2022. During that window, the Federal Reserve pumped trillions into the economy. Mortgage rates dropped below 3%, while inflation raged toward 9%. That combination triggered a massive wave of fear of missing out, driving buyers to throw cash at anything with a roof. This chart shows the sheer scale of the resulting price explosions in pandemic boomtowns. In just 2 years, mid-tier home prices in Austin shot up 62%. Now it's 2026. A lot of young professionals in their mid-30s finally have stable jobs and a solid down payment ready to deploy. You want more space to start a family. But looking at these shifting charts creates a paralyzing fear. No one wants to catch a falling knife and buy an asset that's rapidly losing value. If you misread your local market right now, you either wipe out years of hard-earned equity or you stay on the sidelines and get permanently priced out of homeownership. Let's examine the first major reality, the crashing boomtown. This graph illustrates the correction in formerly red-hot markets. Since their 2022 peaks, mid-tier homes in Austin plunged 26%. Oakland is down 25%. Buyers entering today are purchasing assets actively bleeding equity month over month. There is a severe trade-off here. You might finally secure physical stability and a place to call your own, but you take on the heavy risk of your mortgage balance eclipsing the actual value of your home. If there is any chance you might need to sell or relocate within the next 5 years, buying into a boomtown correction is a massive gamble. Our second reality isn't driven by broad economic trends at all. It's strictly isolated, driven entirely by highly concentrated local wealth. Welcome to the AI microbubble currently infecting the San Francisco housing market. The math here seems backward. Total employment in the city is actually dropping, and the unemployment rate ticked up. Yet demand for housing remains exceptionally ferocious. This flowchart maps the cause. Highly paid AI workers are trying to buy luxury properties, but face a severe mansion shortage. So excess cash is overflowing and flooding into standard mid-tier homes, driving up their prices. For average buyers looking for a starter home, the trade-off is brutal. You are forced to compete against cash-flush tech workers, throwing easy money around, even though prices are technically below 2022 highs. Extreme concentrated tech wealth has the power to completely decouple a city's housing market from its underlying economic health. That brings us to the third distinct reality, the slowly appreciating legacy cities. These are mature markets like New York City, Chicago, Philadelphia, and Omaha. This chart tracks their current trajectory. Notice the complete lack of a wild pandemic spike and crash. Instead, these cities slowly inch up to brand new highs. Buying here offers robust protection for capital without exposure to sudden, violent market corrections. But the cost of that safety is high. You are forced to commit massive amounts of upfront capital at the absolute historical peak of the market. Legacy cities offer a safe harbor, but only if you are willing to accept significantly lower upside potential than historical real estate averages usually deliver. No matter which of these three markets you live in, expensive single-family homes push buyers toward cheaper entry points. Condos initially look like the perfect budget-friendly alternative, but there is a massive hidden vulnerability here. Condos expose you directly to sticky service inflation and the severe danger of critically underfunded HOA reserves. Look at this budget breakdown. If the building needs major maintenance, a 10% annual fee hike or a surprise special assessment violently expands your costs, instantly obliterating your monthly cash flow. A low initial purchase price is nothing but a dangerous illusion if uncontrollable external maintenance fees break your budget down the line. The old, unquestioned societal rule that buying real estate anywhere is always a good investment is permanently dead. Let's build a decision framework, starting specifically with viewers located in those correcting Sunbelt and boomtown markets. Do not try to catch the falling knife. Instead, deploy what we call the strategic rent. To execute this, you bypass massive corporate apartment complexes. You find a private landlord with a house for rent, and you negotiate a 3 to 5 year lease. The crucial mechanism here is control. You must secure a capped annual rent increase written directly into the contract. Lots of landlords will gladly trade a rent discount for guaranteed long-term occupancy. This strategy delays homeownership, but it strictly protects your hard-earned down payment. You maintain housing stability while letting the local market absorb another 20% drop on the landlord's dime. Now, let's pivot to the framework for viewers located in those appreciating legacy cities, where prices are continuing to rise. If you buy here, there is an absolute prerequisite. You must plan to stay in that home for at least 7 years. You need that buffer to weather any unforeseen market stagnation. Skip the condos entirely. Focus your search exclusively on single-family homes with strong curb appeal, ensuring you have a highly liquid asset if a sudden sale is required. This comparison illustrates your core trade-off. Yes, you are paying top dollar today, but you permanently lock in your housing costs against 7 years of future inflation. Whatever market you live in, the most important factor is psychological. Do not let societal pressure or a renewed sense of FOMO rush you into a $500,000 decision. In the deeply fractured market of 2026, preserving your financial flexibility and exercising patience are just as valuable as building home equity.